It's very interesting. Okay, now you are just entering the subjects. Okay, we have the assets, is it right? You have the assets, financial assets, and you have the financial liabilities. It's very easy. Okay, totally calculations. Okay, totally calculations how it happens. Now when you are talking about the financial liabilities, what will happen? Take the real examples what you are doing. Is it right? You are there is a rules. Okay, again same thing. Where is that? Everything is rule. You are talking in terms of accounting standards. Okay, accounting standard. There is an accounting standard for 32. There is an accounting standard for 39, IS 39. There is an accounting standard for IFRS 9. Okay, you have a IFRS 9. We are taking that one only. How we have to identify? Very simple, very practical example. I will make you understand. Now first we will talk about financial liabilities. Okay, financial liabilities are what are they? You are talking in terms of equity. Is it right? You are talking in terms of loans. Fine, loans, very important, loans. Okay, short term loans and long term loans. Now first we will come easy things we will understand. All are easy, by the way. Okay, don't say that it's all. When you are talking about, you have taken a loan. Okay, you are taken a loan of how much? 10,000. Now what will happen? Every time you are paying off the loan, what will happen? As simple as that, loan amount will decrease. Is it right? You are taken the loan, assume you have taken a loan of 10,000. You have made some investments. Is it right? You have made for investment. You have made investment at the rate of 2%. Okay, and you will pay interest cost. Okay, you will pay interest cost at the rate of 3%. You are getting an income of 2%. You are paying a interest of 3%. Definitely, what will happen? In the opening, you will have opening balance. At the end of the year, you will have a closing balance. Is that at the end of the closing balance? Whenever we are talking a loan, we are talking it in terms of fixed duration. Is that fixed duration as such? When we say it's a fixed duration, the value of the loan decreases as you pay the loan amount. As simple as that. Nothing is new. We are going to explore something which is not realistic. As the value of the loan decreases, we have to take that into consideration. Okay, when it is decreasing, we call it as amortization. Okay, we call it as amortization. Fine, very simple. Are you clear? Now when I am doing this, you will have the opening balance. If we are making any investments, we will, what is the rate of interest? What is the rate of interest we will receiving? We will add it. What is the rate of interest we will pay? We will deduct it, and we will take the closing balance. In the question, they will ask, okay, if it is given in section B, they will ask for 1, 2, 3. They will ask what is the amount in year 2, what is the amount in year 1, either what is the amount in year 3, or in section C. Okay, all this comes in section C. Okay, yeah, all this till lecture 15. In section C, they will give you one adjustment for how many marks? One adjustment for 3 marks. In the preparation of balance sheet, financial statement, they will give one adjustment of financial instruments. In the same way, this is the most important thing. Is that now you have different types of financial assets, different types of financial liabilities. Okay, we will make it a point that how financial assets and financial liabilities are treated in statement of financial position. Basic understanding we are doing. Okay, basic understanding here. Now coming back to this. Okay, coming back, explain the need of accounting standards. Why there is a accounting standard? We define what is the financial instruments. Okay, what is a financial asset and what is the financial liability. Fine. Now we are doing the things when we are talking about the how we have to categorize, how you have to classify financial instruments. Is it how you have to measure it? Is it sometimes what will happen, you will gain, you will lose. Definitely when you are talking about accounting, there will be gain and there will be loss. Now I am telling you in advance, if it is a long term, if it is a short term, is it right? If anything it is a more than 1 year, we have to show in other comprehensive income. Anything, the same rule we will apply. What we have done in the IS second chapter 2, the non-current assets, the same rule applies everywhere. If it is for a long term, we will show other comprehensive income. Why we are showing in other comprehensive income? Because it's happening once in a while. Is that if it is a short term investment, if there is any gains and losses, especially gains, okay, anything, then we are showing in the income statement. Then we are going to show in the income statement. That's treatment what we have done there. The way we carry forward the same treatment when we are doing this. Okay. Now when we talk about gains and losses, what is their amortized cost? Amortized cost is nothing but we just told you. You have taken a loan, you will repay the loan amount will decrease. Fine. That's as simple. The moment you are paying the loan, you will see what is the loan amount, principal amount. Is that loan amount? If you are got any interest and you are going to pay any interest received and interest paid, if any. There are two things. Fair value. We have done the fair value. Again, revise this. We are doing the same thing. IFRS 13. Now every chapter we are doing, we are going to work out what we have learned, the concepts. Nothing new we are going to work out on that. Is that you will have fair value through OCI and fair value through profit and loss account. Is that we'll do this. What are the requirements? What is the requirements related to IFRS standards in terms of issue and finance cost? Finance cost is nothing but very clearly interest expenses. Is that interest expenses? Now, when you do the things, for the equity, what you will do for the equity, we pay dividends. Is that for the equity? You have preference shares also. Preference shares are older. Very few instances, very few companies will have preference shares. Very few companies in the world. Selected companies. Okay, most of the time we will have equity shares. Exceptional cases, preference shares. And we have the debt instruments. Debt instruments with no conversion rights. Is it right? Now, means it's a straight loan. Okay. Now you will ask me, what is the conversion? Is it? When you are taking conversion, whenever we write a loan, we'll say 10%. 10-year loan. Is it right? 10-year loan. Or what are the different options? 10%, 10-year convertible loan. When we say it is a convertible loan, convertible into what? Convertible to equity shares. Is it convertible to equity? They will say very clearly, there is no ambiguity, there is no confusion, there is no missing data. Conditions are very clear in F7. In SBR also, they will give everything, they will give very, very clearly. Okay. Conversion. Conversion means convertible. Convertible into equity shares. We will do this. Convertible debt. Okay. Convertible debt. Explain an account factoring receivables. Is that factoring receivables? Receivables is a financial asset. Okay. Receivables are financial asset. In simple words, I will tell you. Okay. In simple words, I will tell you. What happening? People will take the example of finance companies. Okay, take the example of finance companies, automobile companies. What they will do, they will say that we are selling, we are also give loans. Okay, we will give post dated checks. Customers will give post dated checks. Now assume you have 100 customers, is it right, into 12 months. Okay, into 12 months, each customer will give a post dated checks of 200 reals. Is that each customer will give a post dated check of 200 reals. Now how much will be there? Multiply it 100 times 12 times 200. It comes to how much? It is not a small amount. It is 240,000 reals. Immediately what the finance company will do? They will approach a bank, factory. They will approach the bank and say that this is the post dated checks are with me. Checks will never be, if checks are dishonored, it is a crime. Okay, if checks are dishonored, it is a crime. It's a huge penalty the customer has to pay. They say that fine, 240,000. These are guaranteed recovery. I want cash. What the client will do, they will approach a bank and like a discounting. Okay, they approach the bank and say that yes, these are the things. Bank will say, they will charge some commission, whatever it may be, charges, and they said, okay, we are giving 235,000 to you. Okay, the 5,000, 5,000 is a huge amount. Okay, 5,000, we'll say that yes, we are deducting 1,000 and we'll give 239 to you. That is about factory. Okay, we will cover this when we are going to complete at the end of this chapter. Okay, now what is very clear in our approach? We are talking about financial assets, financial liabilities, conversions, and more importantly in terms of receivables. Fine. Now what are the things we are having? What are the financial instruments? You have financial liabilities, financial assets, capital and debt. Okay, equity, capital and debt. Now clearly, the same approach which we have adopted, anywhere is there, I will make it a point of revision. A finance is a contract that gives rise to financial asset of one and financial liability or equity instrument of another. See, for you it is a financial asset, for other person it is a liability. Okay, for one company it is you are making an investment. Okay, you are making an investment in equity shares. Is that you are making an investment in equity? For you it is an investment, but for the firm it is a liability. Is it right? It is a equity and liability. Now that's what we are talking about. In recent year there is a huge growth worldwide. They are talking about all those things. Read. If I am not reading, read. Understand point? At least once you read. They are talking about there is a significant growth in number and complexity of instruments. Now people are everyone is investing in equity shares. Is that worldwide? Previously we are restricted to one country. Now it is not there. You can invest across the world. Okay, you can invest across the world. In order to, when they have made this rule that you can invest across the world, definitely there will be some rules. There will be some standards. Is it? If it is not there, definitely there will be some problems will be there. There have been practical problems with derivatives. We are not covering this now, okay, but we will cover this in professional level. Derivatives. Okay, derivatives are what? You have forward, future, swaps. In financial management also we will cover. Okay, in financial management we will cover as of this. Here we are not going to focus that much. Here they have mentioned only the reference. Okay, you have sometimes what will happen, you will have unrealized gains and losses. Many financial instruments are not recognized. See, you are making an investment. Assume you have made an investment. Okay, you have made an investment in equity shares. What will happen? You are not selling it. Sometimes the value will go up, and there is a possibility that the value will also decreases. Is that equity share value will also decrease? You are not selling. You are just holding it out. it is called as a unrealized gain. Is it unrealized gain on financial instrument? Is that entities could choose when to recognize profits on instruments in order to smooth profit. People are there, is that they will say yes whenever there is losses are there. Is that companies are very very smart enough that as per the situation, if there are losses, then they will match up the losses with selling of shares, selling of equity. They want loan, then they will see what are the financial instrument alternatives are available. Is that as a smart finance manager, definitely you will explore all these options. Okay, you will explore all these options. Fine. Now, what are the things we are going to cover? IS 32, Financial Instrument Presentation. IFRS 7, is it? Financial Instruments Disclosure. And IFRS 9, it is reporting, financial instruments. Is that basic thing, basic foundation we are understanding. Is that what IS2 deals with the classification of financial instruments. Is that classification means where it is going to be equity, it is going to be non-current liabilities, it is going to be current liabilities. Is it that it is convertible bond loans, convertible bonds, debentures. They will mention all the things. Classification is nothing but actually whether it is a, I will write very clearly, whether it is a equity, is it right? Whether it is a bonds, okay, whether it is a long-term loan, is it? It is a long-term loan, whether it is a current liability. You have to classify in the right place. That's very important. Okay, as per the rules, as per the criteria, you have to make very specific. IFRS 9, what it says, measurement, how you are going to measure it. Okay, how you are going to calculate it. IFRS 9. And IFRS 7 talks about how you are going to disclose in the financial statements, how you are going to present in the financial statement. Three things are there. IS 32 is classification. Memorize this. Okay, when I say memorize, you have to memorize. Always I will say the first one is memorize, the second one is you understand, the third one is you remember. Is it right? I follow this rule. Okay, understand. Memorize means there is no other alternative. Okay, we have to. IS 2 talks about IS 32 talks about classification. IFRS 7 talks about disclosure. IFRS 9 talks about measurement, and IFRS 7 talks about the disclosure. Fine. Now, what is the asset? Nothing is there. Don't worry that we are only refreshing our knowledge. Understand, man? We are only refreshing our knowledge. We know everything. Every other thing we know. We have a cash is asset. Anything we are going to receive, okay, from other people is a asset for you. Okay, in terms of receivables. Is that anything you are going to receive from others, it is a receivables. A right to exchange assets or liabilities. Is that you are exchanging the assets and liabilities. But what is the asset? You are exchanging potentially favorable. What is an asset? Favorable means you are getting some benefit. Okay, you are getting some benefit. Is it? That is under conditions. What are the under conditions that are potentially favorable? An equity instrument of another entity, it is nothing but investment. It is nothing but investment. Okay, what is the financial assets? You have cash, you have anything which you are going to receive from others in the form of cash, any contractual agreement which is going to have conditions are favorable, potentially favorable, and any investment we are doing. Once we are making investment, is that investment, it will be both long term as well as short term. What are the examples? Now you see that you have the option trade receivables. You have the options. What I say options? You have the option to receive or option to sell. Is it right? This is with respect to what? Derivatives. Okay. Just hold it for a while. Okay. Hold it for a while. We will cover this in the later cases. Investment in equity shares. Okay. This is a financial assets. These are called as a financial assets. Okay, these are called as a financial assets. We will consolidate on this. Understand what is the financial liabilities? Any doubt? Are you clear about this till now?
Yes, doctor.
Fine. Okay. What are financial liabilities? You have to deliver cash or finance to another entity. You have taken the loan. Is it right? When you receive the loan, we will smile, very simple. But at the time of payment of loan, our smiles will not be there. As simple as that. Okay, very simple. I'm telling you so that you should understand what I'm telling. To exchange financial assets or liabilities with other entity under potentially unfavorable. When we say unfavorable, it is a outflow of cash. When we are saying it is a potentially favorable, it is a inflow of cash. Okay, it is an outflow of cash and it is an inflow. That will or may be settled in equity instruments. Is it? That may be settled. You are selling equity, means you are selling some investments. You are selling some equity. You are selling some shares, and you are going to pay it off. Okay, you are going to pay it off. Okay, you have to pay it off. What are the things? You are talking about payables, trade payables, credit purchases. Is that you have to pay? Is that credit purchases? Debenture loans. You have taken loans, you have to pay it back. Okay, you have redeemable preference shares. Okay, equity shares will not be repaid. Preference shares we have to be repaid. Again, preference shares, there will be a condition, 9% redeemable, irredeemable. Is that redeemable? Is that redeemable, irredeemable? They will very, very clearly, clearly they will give the conditions. Okay, 9%, 5 years. Is that 9%, 5 years, redeemable, irredeemable. Likewise, they are. What is happening? Preference shares means you have to return that amount back to the shareholder. Whereas in terms of equity shares, the amount will not be returned. If you own equity shares, if you have purchased equity shares, if you are not satisfied, you can sell to some other person. But the company will, extreme cases, there are situations, okay, there are situations where the company will buy the shares, buy back, but that is extraordinary, exceptional cases. Okay, that is what are the here financial liabilities? Payables, loans, and preference shares. Fine. Now these are the things. Now what is, we have to be very clear about finance. What are financial assets and which of the following are financial instruments? Inventory. We will say it is inventory is not an instrument. Understand why? Inventory is not a financial instrument. Inventory is something you have bought it for conversion. Okay, inventory is not a financial. Remember this. Understand why? Remember this. This will be there somewhere in MCQ. Is that inventory is not a financial instrument. That's all I will say. Is it right? Since there is no present, there is no obligation. Is it right? Now, what is we are talking about investment in ordinary shares. Is it right? if you are talking about investment in ordinary shares, you are making investment. It is an obligation. There should be an obligation. Is that an investment in ordinary shares is a financial asset? It is a equity instrument of other company. You are making investments. It is a financial asset. Okay. Prepayment of goods or services. Is that prepayment of goods or services is not? See, you are paid in advance. Is that prepayment? You have paid in advance. Yeah? You have paid in advance. It is just where we are showing. We will show it in a current assets. Okay, we will show it in current asset, but it is not a financial instrument. Okay, means all things that's shown in the current assets, you are going to show it in the current asset, but it is not a financial instrument. It's not a, since no, you are not going to have any future benefit. Is that? Or what the fourth one, liability for income taxes. Is that you have to pay the liability. It is a current liability. Is that you, the moment you will say it is liability for income tax next year. Is that it is not an instrument. There is no contractual agreement. Is it right? There is no finance. It is a statutory. Is it right? By law you have to pay taxes. Is that? But there is no contract. There is no contract between you and the government. But there is a law. By law you have to pay. That's all. Okay? Means if it is by law, it is not a contractual, it is not a financial instrument. It has to be, what has to be there when you are talking about a financial asset or financial liability, there should be some contractual agreement. Give and take, favorable or unfavorable conditions. Is it right? A share option is a financial, since there is a contractual obligation. Is it? I will say that yes, after 6 months, is it right? After 6 months I pay. Is that after 6 months I pay? That's the option. Is it right? You are buying a car. Okay, you are buying a car. The value of the car is how much? 10,000. Now you will do. You are giving an advance payment. Okay, you will give a check. Is that you are giving a check? It is a contractual agreement. Is that I am going to pay you a sum of 1,000 to you. Check is a financial instrument. That there is a contract between one party and other party. Fine. So inventory is not a financial instrument. Okay. Investment in ordinary shares is a financial instrument. All are assets, but you have to differentiate which is a financial instrument and which is not a financial instrument. Fine. This is with respect to financial assets. Okay, this is with respect to financial assets. Examples, okay, financial instrument. Now coming back to financial liabilities. Financial liabilities, how you have to recognize. Recognition, measurement, okay, recognition and measurement is very important. Where you are going to measure? We are going to measure as per IFRS 7. Is that IFRS 7? Go back to that. I will again for your understanding. Is it right? 1 minute. Sorry. It is what? It is 1 minute. It is IFRS 9. Sorry. If IFRS 9, where what you are doing? You are making a measurement. Now, financial liability, I told you in the beginning, very simple, very easy way to score marks. Very easy way to score marks. A liability is recognized at fair value. Usually net proceeds of cash received and any cost of issuing the liability. Is that net proceeds of cash? What is the financial liability? You are talking about 10,000. Is it right? You are talking about 10,000 loan. Is it right? In some cases, what will happen? You have to pay some processing charges. Okay, you have to pay some processing charges. Processing charges are 100. Is it? Processing charges are, this is the fair value. Is it? This is the, what is the net proceeds? Net proceeds is going to be how much? Net proceeds is 9,900. The first one, a financial liability is initially recognized at the fair value. This is usually the net proceeds of the cash received, less any cost of issuing the liability. People will issue bonds. Is it right? People will issue bonds. Companies will issue bonds. Okay? When companies will issue bonds, they will be what? They will be, you will come across issue cost. Is that? You will come across issue cost. Now what happens? Company is issuing bonds. Again, company issue bonds of 100,000. Is it? 100,000. There is a issue cost of how much? Issue cost of 1,000. Is that? How much company will receive? Company will receive 99,000. But company, how much they have to pay? They are receiving 99,000 fine, but they have to pay to the clients how much? 100,000. See that? This is the issuing cost. Now we have to understand what is the fair value minus issue cost is the net proceeds. Fine. The first one, what it says, see the thing. Financial liabilities will carry out amortized cost. What is the amortized cost? Amortized cost is nothing but the closing balance. Amortized cost is used where there is a fixed time duration. Is it fixed? The impairment and amortization. Impairment, indefinite life. Amortization, finite life. Okay, definite life. Amortization. Is that how you are going to calculate? You have, I will put the things. Is that this? Is that this? You automatically we were doing again and again the same thing. Again and again we'll do the same thing. Is that you have the initial cost? Is that assume initial cost is 1,000. You may earn interest of 20. Okay, you may earn. Take an example. Okay, you will earn. They will mention that you are making and you are receiving interest at the rate of 1%, 2%, 3%. Is that you are paying interest at the rate of 3%. Okay, assume you are paying how much? You are paying interest of 3%. What will happen? You will have initial value, you have effective rate of interest, you have interest paid. What will happen? It comes to how much? 120 minus 1020 minus 30, it comes to 990. Check again. 1000 plus 20 minus 30, it comes to how much? 990. It comes to how much? 990. Likewise, you should know. Now, what we do, we will charge interest on, this is the closing balance. Is it? This is the opening balance, initial value is the opening balance, plus effective interest, how much you have received. Effective interest, they mentioned in the question very clearly. In other words, it is nothing but interest received. Is that people are there? See, companies, what they will do? They will take the loan and they will manage in such a way that they will not keep that loan amount idle for even 1 month also. Okay, they will plan in such a way. You memorize this. I am putting it in star. Okay, I am putting it in star and I am putting in a purple color. Fine. Now that's only you have to. Now what happens? The effective will be the effective interest will be different to the interest paid if there are any additional cost of borrowing. There are some premium will be there, some issue cost will be there, some discounts will be there. You are talking about the premium, you are talking about the discounts, you are talking in terms of the issue cost. Sometimes what will happen, an example of liability is a deep discount bond. Is it? The 100,000, this is bond, this is the face value. Face value is how much? 1,000. You are issuing when? You are issuing in 2024. It will be redeemed when? Paid when? Assume it is going to be redeemed in 2029. You will issue this bond, is it right? You will issue this bond at 650 reals. Keep it in mind, 650 reals. You will not pay anything. If you are working in the banks, you have more clarity in this. You are working in banks, you have more clarity in this. You are issuing at 650. When you are redeeming it, you will redeem it at 1,000. You will not pay any interest. Means at the time of investment, the investor will pay how much? The investor will pay 650 to buy the bond. Okay, I am paying 650 to buy the bond. After 5 years, how much I am getting? I am getting 1,000. Is it? Banking people, finance people, you will catch it, these things very, very easily. Okay, this is where we will have the concepts. Okay, what it says, see the thing. One common form of financial instrument is deep discount. Issued at a significant discount of nominal value. Significant discount. Typically a coupon rate of payment much lower than market rate. Is that you are issuing at how much? You are issuing at 650. Market rate is 10%. You are issuing how much? You are issuing only 2% only. You will compensate, okay? You will, the company will compensate, okay? Compensate means they are not matching with the things. You will not lose. Keep it in mind, okay? You will not lose at all. Is it? They will not lose at all. What is the typically a coupon rate of interest much lower than market? Market rate is how much? Assume market rate is 8%. How much you will offer? 2%. How much you will offer? 2%. Fine. But the condition is now you are paying 650, then you will get back how much? 1,000. Now you will have that advantage. Is it what happens? Full cost of borrowing is likely to include issue cost, whatever the issue cost, whatever the discount on issue, you have annual interest payments, is it right? You will have, everything will be covered. Is it right? Everything will be covered. It's not like that 100 minus, you have the difference of 350. People are very smart, okay? People are very smart. They don't want to have a commitment every year. They say that you pay 650, after 5 years I will pay you 1,000. Fine. And definitely every person will have their different requirements. I am having different preferences. You will have different preferences. Your preferences will match according to this. You will take this option. Is it? In the market, you will have all the options in front of you. Is it? The initial carrying amount of the bank will be net proceeds of the issue. The full finance cost will be charged life of the instrument, whatever the finance charges. Is it? Finance cost, interest cost, okay? To give constant periodic rate of return. The constant periodic rate return sometimes called as effective rate. Is it? Sometimes called as effective rate. In the examination, in the question, they will mention effective rate. Is it? Periodic rate. Is it? Is that periodic rate means what is the, see what happens. Now I will be more specific about this. Is it now you have issued in 2024, is it right? The you are going to redeem it 2029. See, if you take the rate of interest, is it right? If you take the rate of interest, it is not changing here, okay? But every 3 months, the central bank will issue the rate of interest. Is it? They will revise it. Maybe they are not changing. Depending on the situation, they will do. But usually rate of interest will be revised every 3 months. Is that every 3 months by the federal bank, by the central bank, okay, by the federal bank or by the central bank. Now, this rate of interest will change, hopefully, if it is changing from period to period. Maybe there is a possibility that it will change from one period to another. That rate of interest is called as a effective rate. Is it? That rate of interest is called as a effective rate. Fine. Now, these bonds are, like most liabilities, will be measured. See the thing, nothing is changing. Okay, rules will be same. The initial value plus effective rate minus interest paid. Is that initial value plus effective rate? Now I will give you more information about effective rate. Now you have taken the loan. Okay, you have taken the loan. You have taken the loan at the rate of 6%. You have taken the loan for 5 years. Take the same. Is it? The loan rate of interest will, once it is decided, more or less, it will not change. More or less. If the rate of interest changed by the federal bank or the central bank, then automatically in those situations it will change. But most likely it will not change. But what will happen? See the thing. Loans will be for a longer term. You will have a housing loan for 20 years. Is it liability? You have a project loan for 10 years. You have working capital. You have something for more years. But whenever we think about investments, investments will be maximum deposits. You take the deposits in the banks. Deposits will be maximum 5 years. As a banker, you will say that go for a short-term deposit. Don't go for a long-term deposit. Because whenever we are talking about the deposits, the effective rate is applied with respect to deposits. The interest rate applies with respect to the interest finance cost. The interest received is nothing but the effective rate. Make the distinction. Effective rate is the interest received. Finance cost is the interest paid. Very straight. Okay. Effective. In the examination, in the question, they will give you what is the effective rate and what is the finance cost. Either they will give a finance cost or they will give a discount factor. Okay. They will give a discount factor. See the thing. Loan issued 100,000. Okay. Loan is redeemable. How much you are going to see? We have issued a loan note is issued. They have issued it what 1,100. They are going to redeem it how much? 1,000. The term of loan is how many years? The term of loan is 5 years. How much is the interest paid? Finance cost. Okay. Interest paid is how much? Interest paid is 5.9%. And effective rate of interest. See the thing. Effective rate of interest means 10%. Show the loan note charges over its life. Okay. Show no loan charges. How much initially it is? How much initially it is? 1,000. Okay. 1,000. How much you are going to charge rate of interest? You are going to charge the rate of interest is how much? 5.9. Is it at 59? Is it right? You are charging how much? 59. 59 into how many years? 59. See the thing. 59 into 5 years. Is it right? 59 into the total finance cost in the debt is the difference between payment required by the debt, which is total is how much? 5 into 59. It comes to how much? 59 into 5.
295.
290. Is it 295? 295 you have to pay interest. Is it? You have to pay interest how much? You have to pay interest of 295. Plus how much you are going to redeem it? You are redeeming by how much? 1250. Is it right? You are redeeming how much? 1250. How much you will get? You are going to pay how much? You are going to pay 1545. Is that? You are going to pay how much? 1000. This is the amount what you are paying? Interest you are paying. Is it right? Interest you are paying how much? Is that? Interest you are paying how much? Interest you are paying 59 into 5. Is that? 59 into 5, how much it will come? It will come to 295. Is it right? 295 plus 1250 means how much you are, and the proceeds of 1000 is how much? Is there? What will happen? You are going to pay. You are receiving 1000. You are issuing loan notes of 1000. Is it? You are paying how much? You are paying 1545. How much you are receiving? Actual payment. Actual net proceeds are how much? You are receiving only 545. Again I will say this, okay? You are issuing loan notes. How much? 1000. Fine. You are issuing at 1000. You are going to pay how much? At the end of the 5 years? 250. 1250. Is that? In the process you are paying how much rate of interest? 295. Okay? In the rate of interest, 1000 minus, is it right? 295 minus 1250. What is the net proceeds you are getting? You are getting a net proceeds of how much? You are getting a net proceeds of 545. You will ask what is the benefit? You will ask, see, when you are taking the loan, what is the benefit? When you are taking the loan, you will pay more. Getting my point? You are going to pay more. You are taking the loan. Is it? You are taking the loan of 1000, but you are paying how much? You are paying 1545. Is it? You are taking a loan of how much? 1000. You are paying how much? 1545. If you take into consideration how much we are getting actually from the loan, you are getting actually loan from the 545 only. Again I will repeat this. You are taking a loan of 1000. You will pay more with interest, including interest. Including interest. The difference between the amount of loan taken and the repayment with interest is net proceeds. Is it clear to you all?
Yes, doctor.
Yes, Hussein, how are you? Okay, fine. Very simple. It's see the thing. Only calculations. Okay, only calculation. Fine. Next, see the things. What is happening? The moments it is like this. You have taken how much? Remember this. The example questions will be only on this. The exam questions will be only on the calculations will be on this only. Beginning balance 1000. How much you are final effective rate is how much? Effective rate is 10%. 1000 into 10, 100. How much you are paying interest? 59. Is it right? This is column 1, column 2, column 3, column 4, column 5 is equal to 2 plus 3 minus 4. Understand point? Column 5 is, I will use the same rule when I am doing this. Column 1 year, column 2 opening balance, column 3 effective rate. Is it right? Column 3 is the effective rate. Effective rate means what is the interest you are going to receive. Column 4 is interest paid. Is right? Column 4 is interest rate. Closing balance is, column 5 is 2 plus 3 minus 4. Please check now. Okay, please 1000 plus 100. How much is the closing balance? 1041. 1041 you will calculate at the rate of 10%. Okay, you calculate at the rate of 10%. Is right? Now you have a fixed rate 5.9%. Okay, you are paying interest at the fixed rate 59. Same formula. Okay, now fifth year is how much? 1190. 1190. How much you are getting interest? 119. Okay, see 1190. See the things. 1190 plus 119 minus 59. How much will get?
1,250.
That done. Basic simple calculation. Is it clear to you?
Yes.
Is it right? Is it clear to you? Nothing is there. I am telling you where there is difficulty, I will tell you difficulty. Very simple. I will not hide anything from you. Okay, I will not hide anything from you. Except if there is a difficulty, I will say it's a difficulty. Fine. Now, see, test your understanding 1. Read first. Everyone. Everyone read. Now, what it says? What it says? A company issue 5% loans. Okay, a company issue 5% loan for the nominal value of how much? 20,000. You assume you are a company. Your company is issuing. Okay, your company issuing. I will remove this. Okay, I need space for me here to write. Okay, I will remove this. I need more space for me. Okay, you assume you are issuing the bonds. Okay, your company issuing a loan notes 5%, 20,000. Effective rate of how much? Effective rate of 5%. And loan is repayable how much? For 4 years. What is the, see, this is the finance cost. Is that? This is the finance cost. Okay, this is the effective rate what you are receiving. Same thing. Okay, initially it is same thing. What will be the amount to be recorded in financial liability when the loan is issued? This is question number 1. What amount should be shown in the statement of profit and loss account and the statement of balance sheet, financial position? How many requirements are there? 3 requirements are there. Is that 3 requirements are there? Debits, credits, perfect. Okay, debits, credits, perfect. Now, first one, what is the amount? How much you are receiving? How much you are issuing the bonds? You are issuing the bonds of how much? Loan notes is how much? 20,000. Okay, loan notes is how much? 20,000. You make like this, write down. I am going to ask you to send the screenshot. Very simple. I am very serious now. Okay, I am very serious now. When you are talking in terms of recording, it is a general entry. Is it? It is a general entry. It is question number 1. What you are issuing, a loan notes. What you are getting cash, or you are going to pay cash?
You are receiving cash.
You receive. If you are receiving that, asset will increase. Whenever the asset will increase, it is debit. Okay, asset increases, it is debit. You are receiving cash in the form of bank, through bank. Okay, now when you are issuing a loan notes, your liability will also increases. Anytime liability increases, it will be liability increases, credit. Liability is decreasing, it is debit. Is that loan? One asset is increasing. How much? Loan notes. Credit is what? Credit is loan notes. Any doubt is there? You have to ask, stop me as and when it happens. Is it? Is that how much is there? It is the 20,000. Fine. Are you clear? This much only you have to do. How it is recorded. What you are doing? We are talking in terms of how it is recorded. Put one line here. Put one line here. Fine. Next. What you have to do, how we have to show it in the financial statements. Okay. Profit and loss. Before that, is it at point number 2? Is it that we are talking in terms of what? We are taking in terms of statement of profit and loss account. Statement of profit and loss. Is that before that we have to show workings. Okay. Before that, the same thing. What we have done in the previous case, illustration we have to do. Is that you have a year. I am going to ask immediately after this screenshot. I'm telling you in advance. Randomly anyone. Here you have a opening balance. Okay, you have a opening balance. You have a opening balance. Is it right? You have a effective rate. Fine. You have a what they have mentioned. We will take the thing. Finance cost. Is it right? Finance cost. How much effective rate? Okay. I will write here for your understanding. This is the effective rate. Effective rate is how much? Effective rate is 5%. Is that you have the finance cost? Is that we have the finance cost? It is also 5%. You have a closing balance. Fine. Keep it in mind. Give it like this. Column 1, column 2, column 3, column 4, column 5 equal to 2 plus 3 minus 4.
Victor,
Yes.
column 4, the finance cost.
Yes. This is finance cost paid. Is it that? This is effective rate of interest received. Is it right? Here we are writing this, but in future I will not write finance cost. I will write effective rate. Now only I will change. I will write effective rate. Effective rate is what you are receiving. Finance cost is what you are paying.
Effective cost.
Is it okay?
Yes, Victor.
Okay. Next. Any doubt you ask me. Okay. Now, if you can do it in Excel, do it in Excel. Okay. Not now, from next class. Okay. But how you are managing, you have to be very, very careful. You can open an Excel file and you can do it. Okay. You can do it. Or once class is over, do it in Excel, because in examination we have to do it in Excel. Okay. Now, what is the year 1? Is that opening balance is how much? How much we have received? 20,000. Okay. 20,000 into 5%. How much we will get? 20,000 times 5%.
1,000.
1,000.
Okay. 20,000. This is plus. Okay. This is plus. This is minus. Okay. This is minus. How much? 20,000 into 5%. How much you are paying? You are paying 1,000.
Minus 1,000.
Is it you are paying? 20 plus 1 minus 1. Incidentally, both rate of interest are same because this is the first problem. How much you will get? You are getting how much? You are getting 20,000 only. Year 2, same thing happens. Is that year 2, same thing happens. Is it right? 1,000. How much is there? 20,000. Year 3, they are giving it for how many years? 4 years. Is it? Year 3, how much is there? 20,000. Is it right? They are receiving 1,000, they are paying 1,000. Usually it will not happen. Understand, man? Usually it will not happen. Is it right? Now, year 4, how much is there? You have 20,000. Is it right? You are talking in terms of 1,000. How much you will pay in year 4? You are repaying. Is it? You will be repaying how much? You prepay the principal amount. Sorry, you repay the interest plus you will repay what? You will repay the principal also. Is it? You are repaying what? It is for 4 years. The closing balance at the end of year 4 will be how much? 0. Are you clear about this?
Year 4 again, Doctor?
Year 4 you will repay it. Okay, you will repay. See, I issued bonds. Okay, I issued bonds to you 20,000. Fine. I issued bonds to you 20,000. What happens if I issued bonds? I will make that investment. I will use it. I have to pay interest to you 5% every year. Okay, I will have to pay 5%. At the end of 4 years, I have to pay interest for the 4th year plus whatever the amount I borrowed from you, the principal amount, I have to repay back the principal amount also to you. Okay, I have to repay the principal amount. Means after 4 years, what will happen? The balance will be when you repay the loan, you have taken the loan. When you repay the loan, is it right? You will pay interest as well as the principal. You have taken the loan for 4 years. You have repaid the loan. At the end of 4 years, what will be the balance in your account? Loan account?
Yes, yes, 0.
0. Okay, and the balance, what is the 0 account? Are you clear about this?
Where it is stated in the question? Because that's why.
Now, where it is, they say repayable at par. Repayable at par. At par means same value.
All right.
Repayable at par means at same value. Okay?
Okay, clear, Doctor. Yes.
Fine. Now, what happens in the statement of financial statements? Okay? In the statement of profit and loss account, what you will do? It is only an extract. Okay? It is only an extract. Means only that item we are showing. We are not showing anything else. Finance cost. Is that finance cost? How much is the finance cost? Year 1, year 2, year 3, year 4. Every year, how much you are showing finance cost? You are showing finance cost of 1,000. Is that in your books you are showing, not in my books? Is that in your books whoever issues in his books, it is a finance cost. You have to pay interest. Okay. In the statement of financial statement position, is that in the statement of, I will put here a small dash. Okay. In the statement of financial position, is it right? In the statement of financial position, make it very clear. Okay, this what is the definition of current liability and non-current liability? Anyone? Anyone? Don't waste time. Yes or no? No means no. Don't worry. I'm here. non-current liability is next 12 months. Immediately next 12 months. Is it? Immediately next 12 months. Okay? Current liability. Non-current liability is more than 12
Next
months.
year.
Is it? Very important. Nowadays, this is one of the hot topic. Understand boy? Hot topic. They will give marks only for this. Fine? Now, when you do the things, which one we have to show non-current closing balance? Which one we have to show non-current liabilities? Which one we have to show current liabilities? That's very important. Here, 20,000 is a non-current liability, more than 2 years. Okay, more than 1 year. This is also non-current liability. Is it? This is also non-current liability. Whereas this 20,000, year 3 closing balance is how much? 20,000. This you are going to pay when we are going to pay in the next 12 months. In year 4 we will pay. In year 4 we will pay 20,000 next 12 months. Is it right? And here the liability will be how much? There will not be any liability. Non-current liabilities and current liabilities. This is the point where they will give you marks. Understand? This is the point where, and this is the only thing we are going to cover in most of the cases. In the statement of financial position, is it right? In the statement of financial position, I am taking the same here, the years, okay, 1, 2, 3, 4. Is it? In the statement of financial position, what I will write? I will write non-current liabilities. Is it? Non-current liabilities, and I will write current liabilities. Is it? I have to, this is what they are asking, how you will show in financial statement. You understand this, you understand 30% of this chapter. 30% of the chapter is clear for you. I am telling you with that much assurance. Okay. Now, in first year, what is non-current liabilities? 20,000. Next year, what is the non-current liabilities? Second year, 20,000. In the third year, it will not be a non-current liabilities. It will be what? It will be current liabilities, because these 20,000 we are going to pay in the next 12 months. Is it right? We are going to pay next 12 months. Is it right? If we are paying anything next 12 months, immediately next 12 months. Third year balance, you are going to pay where? You are going to pay in fourth year. Is it right? If you are paying, yes, tell me please.
The screen is frozen, not moving anymore.
It's not moving? It's not moving?
No.
With me is okay, it move.
Huh?
With me is okay.
To whom it's not moving?
No. Now it's fine.
Is it fine? So I have not moved the screen. I'm doing that. Are you clear about this? Is it okay? When we have to identify non-current liabilities, how we have to identify current liabilities? Is it clear?
Yes.
Okay. Remember, the more we practice, the more the clarity will come. First question, it is beginning. Second question, more clarity. Third question, more clarity. The moment we'll reach the last question, complete clarity. I am telling you this. Fine? Complete clarity. This is what we have to do with respect to, this is what we have done first. We have written general entry. Then we have done the workings. Then we have made the statement of profit and loss account, how it will look. Okay? How it will look in the statement of profit and loss account and statement of balance sheet. Yes, Salim. Take the picture. What you have written. Take the screenshot and send me immediately.
Okay. Send Doctor.
Good. Okay. Very good. Is it? It has to be more clear. Okay. It has to be more clear. I really appreciate you. Okay. You put in group. I will put heart to you also.
Thank you, Doctor.
Okay. Nothing will happen. We are all one. Okay. Next. Are you clear about this?
Yes.
Okay. Now nothing is there. It's almost you have got the concept. Now what the question number 2 says, a company issue 0% loan notes, no interest. Is that 0% loan at the nominal value? How much they have issued? 40,000. The loan will be repaid at premium. Is it right? Effective rate of interest is how much? 9%. Okay, effective rate of interest is how much? 9%. What they have said, the same thing happens. This is the first one, how you are recording, how you are going to show in the profit and loss account, how you are showing in the financial statements. Okay, how you are going to show in the financial statement. I will put this. Again, I will ask anyone to send me the screen. Write how I am writing. It will be more easy for you. Is it right? Now, what it says, the first one, what we have to do, we have to make a recording. How it is recorded, general entry. What is the general entry, Hussein?
It will be interest rate debit.
Huh? Debit will be what?
Interest rate.
Array, debit is the bank. You are issuing loan notes. You will get
No,
cash.
bank will be bank debit and credit will be long-term liability.
Loan notes. What they are issuing? They are using loan notes. Okay? Loan notes. How much? What is the amount?
40,000.
40,000.
11,800.
No. Repayable at premium. You are repaying at premium of how much you are paying extra. Okay, you are repaying at premium. Okay, you are repaying at premium. Is it right? You are prepaying at premium. How much? 11,800. Is that you are repaying at premium? We will do that. Okay. How much you are receiving right now? This is the amount you are receiving. Okay. This is the amount you are receiving. How much you are receiving? 40,000. Okay. How much you are receiving? 40,000. Now, what you have to do? You have to do the working here. Okay. You have to do working here. Same thing. Nothing is changed. Now you see different combinations. Is it right? The first one is year. The second one is opening balance. The third one is effective rate. Is it right? The fourth one is interest paid. Is it right? The last one is closing balance. Effective rate is how much? Effective rate is at the rate of 9%. Interest paid is how much? 0%. Is it right? Interest paid is how much? 0%. Now, tell me, Hussein, how we have to do? One,
First in the year 1.
2, 3, 4, 5 equal to 2 plus 3 minus 4. Okay. Now, how much we have received? How many years? It is for how many years? 3 years. Okay. 1,
For 3 years.
2 and 3. How much we have received? 40,000. Okay. How much we have received? 40,000. 40,000, 9%, how much?
3,600.
Good. 3,000. There is no interest. Okay. 0. There is no interest. Okay. How much we'll get? 43,600. Is it okay?
Same for next year.
Pardon? Tell me.
For second year is the same.
$40,000 is the amount which have been issued. How much you are getting interest received is how much? At the rate, effective rate is 9%. We are getting how much? 3,600. Is that we are getting 3,000. This plus this minus this is equal to this. Is it okay?
Yes.
Now, how much is the closing balance? 43,600. Take 43,600 only. 43,600. 43,600 at the rate of 4%. How much? 43,600. 4%. How much? Sorry. 43,600. 9%. Sorry. 9%. How much?
3,924.
Next. Rate of interest is 0. There is 0% rate. How much you will get total?
47,524.
How much? 47,500?
524.
524. See the thing. 47,524 at the rate of 9%. How much?
$4,277.
4,277.
4,276. How much you will get here?
77 doctor.
77, sir.
Okay, no problem. How much you will get here?
$51,801.
51,800.
801.
You are paying. The liability will become after 3 years. The liability will become
0.
0. Okay. Now, which one is non-current liability? Which one is current liability?
First one is not current liability.
First one is non-current liability. Second one is current liability because it is only 3 years.
Yes, it will be paid.
Okay, it is only 3 years. This is the closing balance for at the end of second year, which we will pay back where we are going to pay back in the next 12 months, in the year 3.
Okay.
Is it okay?
Yes.
Same rule. Now you will not see it. That is the reason. Is that only thing you can do on your own. Trust me. Okay. Now, what we have to show? We have to show in how we are going to show in the state. Now, this is workings. Okay. How we have to show in the point number 2, statement of profit and loss. Extract. Yes, Sumaya, are you understanding?
Yes, Mr.
Any doubt? No, see, where it is not difficult. Okay, 1, 2 and 3. Okay, finance. Is it right? Now, how much is the 3,600, 3,924, Is it 3,924 4276? Statement of financial position. Is it a statement of financial position? Non-current liabilities and current liabilities. Is it right? How much is there? 43,600 dash and dash, 47,524 and dash. Yes, Hussein, send me the screenshot.
In group?
Yes. Are you understanding all four? Hussein, Salim, Hussein, Mazin and Sumayya.
Yes.
Send it, sir.
Good.
Mazen today is so quiet.
Huh?
Mazen today is so quiet.
Alhamdulillah, I will make him active. Don't worry about that.
Yeah,
Inshallah khair. Okay? Fine? Now, be perfect here. What I am doing, be very perfect there. Okay? Now, what they are saying, a company issues 4% loan notes. This is the finance cost. Is it right? This is the finance cost. Is it? Now, 20,000. They have issued a discount. How much? 2.5%. Is it? They have issued a discount 534, and 534 was what? Issue cost. Now you will come across some rule will never change, process will never change. Okay, steps will never change. Only thing new time will come. Fine. How much is? How much is the 20,000? Okay, 20,000. 20,000. Okay, they are issued a discount. How much is the discount? 22.5%. Okay, 2.5% is the discount, and issue cost is how much? 534. The loan notes will be repaid premium. They will going to pay at how much? They will going to pay at the premium 10%. Is it? They are going to pay it at 10% after 5 years. Effective rate is how much? Effective rate is 7%. Is that effective rate is 7%, rate of interest is 4%, they have issued a discount and they have a issue cost. Okay, they have the issue cost. Now first what they are asking, how it is going to be recorded. Same process, recording statement of profit and loss account, statement of financial position. Okay, statement of profit and loss account, statement of financial position. I am putting this, is it right? I am just for your understanding, I am putting one line here. Okay, next. First one, how it are going, margin, tell me. How we are going to record it? See the things. We have to calculate net proceeds. Okay, we have to first net proceeds. What is the face value, nominal value? Nominal value is how much? Nominal value is 20,000. Okay. How much they have discount? Discount at the rate of 2.5%. Is that discount is at the rate of 2.5%. How much is there? 20,000 into 2.5? Anyone?
500. 500.
Very fast. Okay, issue cost is how much you have to deduct issue cost also. How much is the issue cost? 534. Issue cost is 534. How much you will get the balance?
$18,966.
18,000. Any doubt? You stop me. Okay, I will not give that much scope for you. This is called as net proceeds. Is it right? This is called as net proceeds. Okay. Now, what is the general entry for this? Sumaya. What is debit and what is credit? Debit will be bank. Okay, how much you are receiving? You are receiving how much? 18,966. Okay, credit will be what? Credit will be no loan notes. Because we have issued this in the previous, now you compare example 1, example 2, example 3. You will find clear understanding. Okay, this is with respect to point number 1. Okay, this is with respect to point number 1. Now, point number 2. Before we go for point number 2, we have to do it for what? We have to do it. What they say, we are going to pay. We are going to pay after 5 years. Now, what they are asking you, see now this is what actual question. Okay, this is what the actual. If you see the things, what amount will be shown in profit and loss account for the financial position for which year?
Year 1.
We have to do only for year 1. Isn't it? You have to do it only for year 1. We should not do for anything else. How much they ask, that much you have to do. Okay, working. Is that working? Okay, we have to do only for year 1. Year, opening balance, effective rate. Effective rate is how much? 7%. Okay, and interest, finance cost is how much? Finance cost is how much? 4%. Closing balance is how much? We will do that. Okay, only for year 1. Only for year 1. What is the opening balance?
18,966.
18,966 at the rate of 7%.
1,327.
1,327. 28. You can round it off. No problem. Okay,
Yes.
you can round it off. No problem. Finance cost will be how much? Think and tell.
700.
Huh?
750.
No. Finance cost will be always on the principal amount. What is the principal amount here?
758.
20,000. What is the principal amount here? 20,000. You are taking loan of 20,000. You will pay interest on 20,000. Understand point? You will pay interest on 20,000. Issue cost is there.
1,400.
Huh?
1,400.
How much is 4%? 20,000. 4%. How much?
800.
800.
800. Understand my point? Listen carefully. Slowly we are progressing. Finance cost, you are taken loan. See, you are applied for loan. When you applied for loan, there will be some discount will be there, some processing fees will be there. At the end of the time, you will get 18,966. But you have taken a loan. What is the loan amount? Loan amount is 20,000. On 20,000, you will pay interest. Okay? Same process. 1 plus 2, 1, 2, 3, 4, 5 equal to 2 plus 3 minus 4. How much you will get?
19,494.
19,494. Is it
It's
right?
for non-current liability.
Alhamdulillah, that's good. We are doing only for 1 year, okay? Now, is it a statement of profit and loss? We are going to show only for 1 year, is it right? Finance cost. Finance cost is how much? Whenever we are taking finance cost, you should ask me this question. I am waiting for you to ask me this doubt. Finance cost is nothing but the effective rate. Is it right? Finance cost is nothing but the effective rate. How much is there? 1328. Statement of financial position. Is it right? Statement of financial position. Year 1 only. Okay, this is for year 1 only. Extract. Is it non-current liabilities? How much is there? 19,494. Is it clear to you?
Yes.
Is it fine? Yes, Salim, Sumaya, Mazin and Hussein.
Yes, Dr. Mustafa.
Yes, Dr. Salim.
Any doubt? Ask me, okay? You ask me, okay, fine? Make clear. Okay, we are not doing anything. We are just moving one by one. Are you clear about this? This is with respect to loans. See, now I will go back. What we have done, there are 3 things are there. The first, we have taken loan at par, okay? This is at par, at same value. This is at premium, okay? This is at premium. Is it right? This is at premium. And the third one is, this is at discount. Okay, the 3 things are there. One at the par, same value. The second one is at premium. The third one is at discount. This much is there. We don't have anything else. Okay, this is with respect to what? This is with respect to loan notes. Are you clear about this?
Yes, Dr.
Can I go to the next one?
Yes.
Fine. We'll complete a small one. Nothing will happen. Okay. We'll complete a small one. Then we will see how it will work. Okay. Now we are talking about the preference shares. Nothing is there. Same process. Same process we have to do. Okay. Preference shares is no different from this. Fine. It is no different from this. Some preference shares are if irredeemable. If irredeemable, we are not redeeming it, we are not continuing it. No obligation to make any payment. Is that if irredeemable preference shares contains no obligation to make any payments in terms of capital or dividend, they may be classified as what? They may be classified as equity. Is that if there is no obligation irredeemable, is that irredeemable means there is no condition that you have to make any payment in terms of capital or dividend. Is that if it is irredeemable, it is equity. If preference shares are redeemable, fixed cumulative dividends, fixed dividends, is it cumulative dividends? Means cumulative dividends means you are not, the company is not getting profit this year, the company get profits next year, then you will pay the dividends for the current year as well as for the previous outstanding dividend. Then it is going to be classified as a financial liability. When it has to be classified as a equity, when it has to be classified as a financial liability. If it is irredeemable preference shares, no obligation to make any payment. See, usually what happens, equity, the equity shares is no obligation. If there is profits, if there is a profits, you will pay dividends. If there is no profits, you will not pay dividends. Understand point? If it is, make it clear, you will have this doubt. Is that if it is irredeemable, is that if it is irredeemable or it is redeemable, is that it is redeemable, okay? If it is redeemable, here no obligation, is it? It is similar to equity. If you are having profits, you will pay. If you don't have profits, you will not pay. Fine. Here in the second case, conditions are different. There is a contractual agreement, okay? There is an agreement that you have to pay dividends, is it? You have to pay dividends if condition is there, if earning profits. If earning profit, you should not only pay current year, but also you have to pay previous years also. Then it is a financial liability. Now, what is the difference between two? Here you have a contractual agreement is there. Conditions are there. Here there are no conditions. Is it? Here no condition. Keep it in mind. Remember this. In MCQ they will ask you this. Is that in MCQ? If there is no obligation, it is an equity. If there is a contractual obligation, it is a liability. The key element is there is an obligation. The instruments represents a liability. If there is an obligation, it is a liability. If there is no obligation, it is not a liability. I am putting star mark here. Okay, I am putting star mark here, I am putting a purple color. Fine, that's what. Okay, you did this one. The only thing is they gave you some more thing. The accounting treatment of interest and dividend depends on the treatment underlying the asset. Equity dividends declared are reported directly in equity dividends. We are going to show in the equity. Dividends of instruments as a liability will be treated as a finance cost in the statement of profit and loss account. If anything we are talking, see, equity dividends declared will be added to the equity. If dividends on instrument, financial instruments, if it is a liability, then it is going to be treated as a finance cost. Is that if it classified as a liability, is going to be treated as a finance cost. Fine, finance cost in the liability. Fine, good. We will complete this and we'll stop. Now, preference shares, little that is a little bit conditions are different, okay, but process is same. On only wordings are different. That's all I can say that much. On April 7th, they have issued how much? 40,000 redeemable. Getting your point? If it is a redeemable, what is the condition they say? If it is a redeemable, it is a liability. If it is irredeemable, it is a equity. Okay? They say redeemable. With the coupon rate is how much? 8%. Is that coupon rate is nothing but 8%. That they are redeemable at a premium which gives them an effective rate of how much? 12%. Is that effective rate of how much? 12%. Now, effective rate of how much? 12. What would be the redeemable appear in the financial statements? 2008 to only for 2 years. Okay, only for 2 years. Now, same thing. Okay. Now, what they are asking, you have to make the table. Is that year, opening balance, okay, opening balance, is that effective rate, interest paid, closing balance. Fine, interest paid, closing. How much is the annual payment interest we are paying? See, annual payment interest is how much? We are paying at the rate of how much? See, annual interest will be on the nominal value. Okay, nominal value. At the rate of how much? Tell me. At the rate of, what is the rate of interest? Coupon rate is how much? At the rate of 8%. Effective rate will be on the opening balance. Understand? This is the difference. At the rate of how much? Effective rate is how much? Effective finance cost is 12%. Effective rate of interest. This effective rate, we have to show it in the profit and loss account. Is that? This effective rate always, okay? Year 1. How much is the opening balance? Salim?
40,000.
40,000. At the rate of 12%, how much?
4,800.
Good. Next, how much you are paying at the rate of 8% on 40,000? On 40,000, nominal value, always.
3,200.
40,000. Nominal value is how much? 40,000. How much is there? 3,000.
200.
Closing balance is how much? Same thing. 1, 2, 3, 4, 5 equal to 2 plus 3 minus 4. How much?
41,600.
41,600. Yes, margin. Second one. Close opening balance is how much? 41,600. What is the effective rate?
$4,992.
Good. This will remain same. Okay, this will remain same. 3,200. 2 plus 3 minus 4, how much?
$43,392.
43,392. They have given number of years? No, they have not given number of years. They have not given number.
Only for 1 year.
Huh?
I think only for 1 year.
No, my dear, they have given for 2, they are asking for 2 years now. You pay for 31st and 2008 and 2009.
Oh, okay.
Okay, they have asked for 2008 and 2009. Okay, next, fine, no problem. Statement of profit and loss. Is there a statement of profit or loss? Okay, 1 and 2. Okay, finance cost. You have to take effective rate. Okay, you have to take effective rate. How much we have calculated?
4,800 and 4,992.
4,800 and 4,992. Okay, statement of financial position. They have not mentioned. Okay, if they have not mentioned, you take both the things into in NCL only. Okay, you take both the things as
Non-current
non-current
liability.
liability only. Nothing will happen. Is it right? Both the things in non-current liability. Preference. See, on the other way, preference shares will be on very long term. Okay, 5 years it will be there. Okay, non-current liability. Is it right? Preference shares. How much? Year 1 is how much? 41,600 and year 2 is 43,392. Don't forget to write extract. Is it okay?
Yes, doctor.
Can I stop or can I continue?
Enough, doctor.